the loss to investors is more than twice what we saw in 08-09. That's how bad this is. This is going to be quite a surprise to a number of investors. I think that this is getting to be so serious that we are reaching a cathartic moment, and I do think it's started. We think this is a bit of a financial crisis.
Cathie Wood thinks that Jerome Powell is looking at all the wrong data and that the Federal Reserve is going to do serious damage to the economy as a result. While they're focused on stopping inflation, Cathie Wood believes that we're about to see massive deflation. Will the Fed change its mind? Or is Cathie Wood looking too far into the future for her funds to survive the present? Your time is valuable, so let's get right into it. Let me start by saying that I'm a longtime fan of Cathie Wood. I've made over 80 videos talking about ARK Invest's technology research, their market analysis, and their trades. I really believe in their long-term vision of the future, but there's no doubt that many of Cathie Wood's predictions haven't made it to the present, at least not yet. And when it comes to the stocks that she's putting in her funds, being too early can be just as dangerous as being wrong. As a result, ARK Invest's flagship innovation fund, ARK-K, is down by over 60% year to date and just made a new low this past month. With that said, Cathie Wood's predictions could come true sooner than you think, maybe even sooner than I think, based on a lot of leading indicators that show where the economy is heading, not where it's already been. After we talk about Cathie Wood's outlook on interest rates and the economy, I'll show you which stocks she's been buying over the last couple of months. After all, if she's right, the Federal Reserve might reverse its stance on raising rates, which would cause a serious rally in the stock market, especially for the growth stocks inside ARK Invest funds. I'm not saying that will happen, but it's a real possibility that investors should prepare for. That's where moomoo comes in. Moomoo is a free stock trading app that's owned by Futu, which is listed on the NASDAQ. That means that they follow all SEC regulations. They've been around for over a decade and are backed by institutions like Tencent and Goldman Sachs. Right now, moomoo is giving away up to 15 free stocks, each valued up to $2,000. Here's how it works. When you sign up and open an account, you can draw one free stock. If you use my link in the description below, you'll also get an additional $10 coupon for free. Then if you fund your account with $100, you can draw 4 more free stocks. And if you fund your account with $1,000, you can draw another 10 free stocks. Just make sure to keep your account funded at that level for at least 60 days. This is a limited time offer, so go try the app using my link down below and enjoy all the free stocks. Alright, Cathie Wood spent the last couple months really laying into the Federal Reserve. In a recent tweet storm, she compared today's economy to the Roaring '20s, which is where the world saw new game-changing innovations like the telephone, electricity, and the internal combustion engine. Now, in the 2020s, we have artificial intelligence, genomics, robotics, energy storage, and blockchain technology. But in the early 1920s, we also had World War I, the Spanish flu, and inflation touched 24%, all three of which were much more severe than today's Russia-Ukraine war, the pandemic, and our 8% inflation. In the same Twitter thread, Cathie Wood warned that if the Fed doesn't pivot, the setup will be more like 1929, which was the start of the Great Depression. The Fed raised rates in 1929 to squelch financial speculation, and then in 1930, Congress passed Smoot-Hawley, putting 50% plus tariffs on more than 20,000 goods and pushing the global economy into the Great Depression. Unfortunately, today has some echoes of the same. The Fed is ignoring deflationary signals, and the CHIPS Act could harm trade even more than we understand. The reason that Cathie Wood is comparing the CHIPS Act to those tariffs is because microchips are in virtually everything we use today. So raising their production costs effectively raises prices on all of the goods that they're in. But what about the deflationary signals that Cathie Wood is talking about? Aren't we still seeing inflation across the board? To answer that, let's turn to Cathie Wood's October episode of In the Know. I've cut her 40-minute episode down to just the few minutes that focus on what the Fed is missing and what she thinks comes next for the stock market. After that, we'll take a look at which stocks she bought inside her ARK Invest funds. Hold on to your stocks, this is a pretty spicy clip.
I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. So we took a look at the data for the last month because the Fed is saying that it's data-driven. So if it's data-driven, let's do that. The used car price index is going to collapse here. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. And as I mentioned, used car prices were up 54% on a year-over-year basis at one point. Now they're flat to down. And now dealers who were paying too much for used cars are sitting on losses, and they are going to have to disgorge those inventories because inventories cost money to carry. This is going to be quite a surprise to a number of investors. What's another weak link in the United States? Well, this is becoming a big problem for certain sectors of the economy that are in the throes of disruption, both cyclical and secular. And I think the retail sector is one of those. We remain astonished at the inventory buildup taking place out there. Nike's inventories, well, first of all, its global sales were up 3% in this last quarter. Its North American inventories were up 68%. And the inventories in transit were up 85%. So you know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And so we think this is a bit of a financial crisis. And we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. So let's go to the commodity prices. Again, data-driven Fed. Are you listening? So the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%, silver down 29%, DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these as saying, yeah, but that's, they went to sky high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. Lumber is down 28% on a year-over-year basis. I think this is getting to be so serious that we are reaching a cathartic moment, and I do think it started. In the U.S., among major employers, 300 have announced layoffs, and those layoffs, which are broad-based company layoffs, are up 68% year over year. So just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening, but we don't think it's happening. I just rattled off lots of examples. Markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the U.S. alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08, 09. That's how bad this is. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. If the Fed's close to pivoting, even in its rhetoric, I think we are. There are all kinds of reasons out there, data-driven reasons. And so we hope the Fed is paying more attention to all of the data instead of just a selected few pieces of lagging indicators.
Alright, I appreciate you watching that clip because it really provides the context for Cathie Wood's latest trades. For about the last 2 years, I've been grabbing ARK Invest holdings data and looking for trends and changes over time. So let me show you what trades she's been making since she recorded that video. That way, if you agree with her, you know what kind of growth companies to watch. Or if you feel otherwise, you know which ones to avoid. I'll share my own opinions after I show you the stocks. Here's a table of ARK Invest's biggest positions when you combine Cathie Wood's 6 actively managed funds. Each row is one company, the rows are ordered by the size of her position in that company, and each position is colored by its change in size since she made that video last month. That means positions colored in green grew relative to the rest of the funds, which shrank by 12%, and positions colored in blue shrank by more than that negative 12%. Keep in mind that there are 2 ways for Cathie Wood to increase any position. She can either buy more shares, which is shown in the change in shares column, which is this first column, or she can hold shares instead of selling them as they go up in price, which obviously grows the position size, but adds in the risk of the stock going back down if the Fed keeps raising interest rates more than Cathie Wood expects as she makes these trades. That change in share price is reflected in the second column. Either way, the green rows are the positions that ARK Invest is currently growing relative to the rest of the funds. I want to respect your time, so I'm not going to read this full table to you, but let me at least call out a few different ways that you can look at this data. And of course, you're welcome to take screenshots as we go. Since it's currently sorted by combined position size and ARK Invest funds are all conviction weighted, these are Cathie Wood's highest conviction stocks overall. Out of those stocks, the ones she's growing the most are Zoom, Exact Sciences, Roku, Square, Shopify, Unity Software, and maybe Pacific Biosciences, depending on how far down this list you want to go. Now let's sort the table by the change in share count instead. These are the stocks that Cathie Wood has been actively buying as their prices have collapsed over the last 2 months. If you're looking to invest in potentially disruptive, high-growth companies at even cheaper prices than ARK Invest, consider looking into Coinbase, Ginkgo Bioworks, Twilio, CareDX, the Grayscale Bitcoin Trust, and Schrodinger. The reason these rows are so blue is because their prices crashed and Cathie Wood didn't buy enough shares to make up for that drop in price across her funds. She's also been buying more familiar names like Unity Software, Roku, DraftKings, and Tesla in lower amounts because those stocks didn't crash as hard over the same time period. So here's my opinion. Many of these are incredible companies making huge impacts around the world. Tesla, Coinbase, Unity Software, the list goes on and on. But just because they're great companies doesn't make them safe investments in the short term, especially with the next Fed meeting coming up. I also think that many of the indicators that Cathie Wood talked about suffer from the base effect. Yes, retailers will slash prices and commodities are trading well below their peak. But that's because a year ago, most goods cost way more than they do today, and many of these commodities were near a peak in their price. If you compare them to their levels right before the pandemic hit, instead of at their peaks, almost none of them are down by crazy amounts. So, are we seeing deflation relative to the height of the pandemic? Definitely. But are we seeing true deflation relative to values from before the Fed printed trillions of dollars to raise demand while shutdowns crushed everybody's supplies? That's a different story. One that might cost Cathie Wood a lot more in the short term. Let me know in the comments below what you think about Cathie Wood's stance on the Fed and interest rates, and which stocks you're watching as a result. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to put out more research like this. But at least now you have both sides of the argument for deflation and my thoughts on inflation from this video right here. Or if you want to know what parts of the stock market I've been watching, this episode is for you. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.